Welcome everyone. Thank you very much for joining the British Chamber of Commerce's annual economic briefing. My name is David Kelly and I am the Executive Director of the British Chamber of Commerce here in Singapore. Over the past few months, the Chamber has worked together with its business committees and partners to create relevant and impactful content through webinars and podcasts. I'm absolutely delighted to say that this new digital outreach means that today we're joined by guests from across the globe, including Slovenia, Korea, Thailand, and the United Kingdom. If you would like to ask a question during this session, please find the Q&A function, which will be reviewed towards the end of the programme. The webinar will also be recorded and available on the Chamber's website should you wish to revisit any of the points discussed today. In this webinar, we bring together a truly fantastic panel of speakers, together with co-organisers OMFIF and event partners, the Frey Group. I would like to thank both organisations for their continued support and commitment, as this is one of our major flagship events of the year. I would now like to introduce you to Hugh Wedlock, Director of the Frey Group, to share a few words. Hugh, a very warm welcome to you.
For those of you who don't know who the Frey Group are, we're a UK headquartered company with very deep roots in Asia. In fact, we've been giving to UK expats in Southeast Asia since the mid-1960s. We've always had very close links with the British Chamber of Commerce here in Singapore. And in fact, we've sponsored this economic briefing in each one of the last 10 years. This is the first virtual economic briefing that we've done. But I have to say, I think the panel of speakers is probably one of the most impressive that we've ever had. I was a politics undergraduate in the early 90s, so I can remember Lord Lamont trying to manage his way through a very different type of economic turbulence than what we have today. So I'm really looking forward to his thoughts on the current situation, and indeed the thoughts of all those on today's panel. I'd like to finish up by saying a very big thank you to David and the team at the British Chamber for putting today's event together, and I really hope that everyone enjoys it. Thanks a lot.
Good. Well, thank you very much, Hugh, for kicking us off there, and thank you, David, also for your welcoming remarks. And we're now going to go over to Sam Myers, who's the Deputy Trade Commissioner working at the UK High Commission in Singapore. And Sam, you've got a very interesting background where you've been responsible for science and technology in a number of different fields. And of course, given the fact that we've got this worldwide pandemic, which we're coming out of at different grades and different speeds, Britain seems to be hitting the gold medal table, unfortunately, in some of those areas. I think you've got a very good background to talk to us today, not just about trade and investment, your present job in Singapore, but also about the scientific background and how important science and technology is and will be for combating this menace and others that we might see in the future. So great pleasure to have you on this broadcast. Sam, over to you.
Thank you very much, David. Yes, good to be involved today. I won't be sharing any scientific expertise because it's been about 20 years since I was last in a laboratory. So suggest we save the science for some proper experts. So I'd like to start by thanking the British Chamber Singapore for arranging this session. They're a long-standing friend and partner of the British High Commission and of British companies based in Singapore. I'd also like to add my thanks to OMFIF and the Frey Group as co-organisers for today. I'm delighted to have the opportunity to speak just for a few minutes on behalf of the British High Commissioner at today's economic briefing, and have the mandate of setting the stage for the fireside chat with Lord Lamont and also the eminent panel that have been gathered for the session later to come. I'm going to switch off my camera because of bandwidth issues for a couple of minutes, and then I'll return at the end of the session. So hopefully you'll just be left with the slide in front of you. So I'll start by sharing some recent trade statistics to set the scene. Firstly, almost 2/3 of Britain's economy is made up of trade. Nearly 2/3 of Singapore's GDP is generated by external demand. And total trade between the UK and Singapore increased by almost 25% in 2019 to £17.5 billion. Of course, a lot has happened since then, and we await the trade figures for Q1 2020, but what's already very clear is that there's been a huge and immediate impact from COVID-19. Figures for the fall in global GDP are unprecedented since the Great Depression. Now, Singapore has moved quickly and decisively to support its economy and to reduce the potential for lasting damage, but the scale of the fallout will see a drop in GDP of between 1% and 4%, according to the government here. It looks equally likely it'll be as tough for the rest of the region, albeit to varying degrees. Now, to try and understand some of the impacts of that, we have the emerging results of the latest BritCham survey of British businesses in Singapore. And what's striking is that the pain is clear, and almost 95% of businesses report an impact on their operations. Coming from that, both businesses and individuals alike want to understand how Singapore will manage its way out of the circuit breaker measures, which are currently in place. On the flip side, perhaps some room for optimism is that 97% reconfirm their confidence in Singapore for the long term as a business hub, and 75% of respondents indicate they have sufficient financial support during the COVID-19 period. In the UK, the Chancellor has announced unprecedented support for business and workers to protect them against the current economic emergency. Some of these measures include the Job Retention Scheme, deferral of VAT payments for firms until the end of June, which represents a £30 billion injection, and also £330 billion worth of government-backed and guaranteed loans to support businesses. If you'd like more information on that package, there's a website and a helpline available, and you'll be able to find them by searching for Business Support UK online. So what about my department? So I work for the Department for International Trade, and the focus we have at the moment is keeping markets open and maintaining supply chains. And you may have seen that Secretary of State Liz Truss penned a joint op-ed in the Straits Times and the Daily Telegraph yesterday, Tuesday, on the resolve the world needs to restore and deepen global trade. At the heart of our efforts to keep global commerce moving during the crisis is ensuring businesses can continue trading, whether that be through advice, financing, or removing tariffs and barriers. This includes things like engaging with customs authorities to ensure smooth clearance of UK products, providing advice on trade, legal, and intellectual property problems, and reaching out to exporters and investors to understand the challenges they face and how best to support them, including through webinars like this one. We have our world-leading export credit agency, UK Export Finance, working with banks and insurance brokers to back companies to deal with the disruption of coronavirus, whether through helping them get paid for export contracts, loan schemes, export insurance policy, or direct lending. And it's also worth pointing out that this support does not end with UK businesses. There's a range of tools for foreign investors with businesses based in the UK, such as the Business Interruption Loan Scheme and Corporate Financing Facility. So locally, what about in Singapore? So the British High Commission has been supporting British nationals in the region and in Singapore to get back to the UK, and also important work to help source medical supplies and equipment for the NHS frontline from around the region. The High Commissioner continues to provide regular updates to the British community, and indeed there was a session that BritCham organised just over a week ago as part of that. If I were to sort of start to wrap up by just picking 3 of my own team's priorities at this particular time, they include concluding the UK-Singapore Free Trade Agreement, which will transition the EU-Singapore Agreement. On that, we have reached the final stages of negotiations, and at present, UK businesses can benefit from the EU-Singapore Free Trade Agreement until the end of the transition period. And then from the 1st of January 2021, the UK-Singapore bilateral FTA will be in force, so there's no gap. Second up, I'd pick CPTPP. So the UK is very interested in accession to the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTPP, and this includes Singapore and a number of markets in Asia Pacific and the Americas. The UK already does more than £100 billion worth of business annually with the countries of this huge free trade area, and we're determined to turbocharge our trade with these growing economies. Finally, defending free trade is also a key priority at the moment, and it's been clear throughout this global crisis just how important it is to keep trade flowing and supply chains open. Over the last few years, we've seen a worrying trickle of protectionist measures long before the pandemic, but now more than ever, we need to ensure that that trickle does not become a flood. In parallel with this work to advocate for free trade, we're doubling down our work with BritCham Singapore so that businesses have the support, information and advice to resume trade and investment as soon as they can. Let's just flip back to webcam. So I think to conclude, I would say that it's really important in this period that we don't allow a return to autarky and to supply chain nationalism. And trying to ensure that that doesn't happen is something that governments can't do alone. And so the companies and organizations on this call become really important in terms of advocating for free trade and global supply chains as being a really important part of the solution to get the economy back on track. So I'd like to end by inviting everyone on this call to join up and be part of those efforts, or to continue those efforts advocating for supply chains and free trade as our way out of the COVID-19 crisis. Thank you.
Thanks very much, Sam. And I think that's a very encouraging backdrop to what will still be a few fraught months of negotiations that Britain's going to be having with the EU, which with any luck will come to an end at the end of the year. We're going to be talking to Norman Lamont about this in a moment. Norman, thanks very much for being on the line. I have to say you look the best dressed member of this panel, I have to say that. Can you hear us, Norman? You may be needing to put on your unmute button. There's probably an unmute button somewhere in your control panel.
Okay, actually I was muted by the organization, not by myself.
Oh yeah. Yeah, well done for being on the line. So Norman Lamont is the former Chancellor of the Exchequer in the UK between 1990 and 1993, and has been playing a very full role since then as a member of the House of Lords. He also is a member of various boards and so on. Norman, you look as though you're still having a bit of difficulty with the communications. Can you hear me okay?
I can hear you fine. I'll put the phone down when I'm talking, but I'll listen to you through the phone.
Okay. So first question to you, we're going to be talking a little bit about Britain's relationship with the EU and so on, but how do you think Boris Johnson is doing? First of all, he's now back at work after some weeks, firstly in hospital and then convalescing. The British are not doing that well when it comes to combating this pandemic. How do you think the government is performing, and has Mr. Johnson got a grip on the situation?
Well, I think the British government is doing much like other governments. We're a few weeks behind other European countries, but the trends are looking as though they might be about to turn. The curve is definitely flattening. I wouldn't say that Britain has done worse than other countries. I don't think there's any evidence of that. Like all governments, this has hit the government very quickly in the face. And you know, the British media understandably highlight shortages of ventilators, shortage of protective clothing and so on. But of course, one only has to read the reports of what's happening in France, what's happening in Italy, to realize that these are problems that afflict all governments. So I think the government has been doing pretty well. I think the Prime Minister, never forget, leadership, part of leadership is words and getting the right mood. And I think Boris Johnson is very good at that. And I think he was striking the right note. Of course, we're now at the stage where impatience for a way out of the lockout is rising, and he will have to deal with that. But I think he's very skilled in dealing with expectations. his problem is that the other countries are a few weeks ahead of us, so everybody will be saying France is doing this, Portugal is doing that, why don't we move? We are a bit behind because we got hit by the virus a bit later. So I think, you know, the risks here are enormous. The Prime Minister is hugely conscious that a second spike would be disastrous. At the same time, the risk of an economic collapse, of prolonging the measures too long, is also there. This is a hugely difficult balancing act to make.
We've got a major program of borrowing underway, with the Chancellor having now announced practically a quadrupling of borrowing in the next few months over and above what was expected already. How can Britain cope with this huge increase in borrowing? You've recently advocated that there shouldn't be any attempt to go back to any kind of austerity or tax rises. Do you think Britain and other countries in a similar position can actually get through this without some sort of ruinous state bankruptcy?
I do think borrowing is going to be a very considerable problem. I saw an estimate the other day that borrowing for all developed countries, I don't know whether that meant G7 or what it meant, but all developed countries might be around 150% of GDP. If that's the average, that means some countries are going to be much higher. I wouldn't think Britain would be much higher, but it's very difficult to know what the costs of, say, the furloughing scheme are likely to turn out to be. So borrowing is going to be a problem for all the countries of the world. I didn't the other day say there should be no austerity. I think the question of borrowing will have to be addressed, but I don't think it would be right to try to address it immediately in the short term. I think in the short term, once the restrictions are lifted, we won't be back to where we were before. You know, when people talk about a new normal is not normal. Normal is the only thing that is normal. And, you know, a restaurant that can only have half the customers it used to have is not going to be able to survive. And, you know, when you think the British economy, you know, has a large entertainment, a large hospitality, a large tourist sector, social distancing continuing is going to make it very difficult for the businesses in that economy to be viable. And this is a big threat to the economy. I saw the other day that tourism is estimated to make up 10% of European GDP. Well, tourism can't function with social distancing very easily. So I don't think there will be a V-shaped recovery. There may be a V-shaped recovery for a few sectors, but certainly not for the economy as a whole. I think we'll get back maybe to 90% of where we were. And after that, it will be a snail's pace until we actually get to the point where we have a vaccine.
Hello?
So you've written recently, Norman, that the British people, if anything, are getting slightly comfortable with the lockdown, because after all, there has been some relatively generous government measures to cushion the blow. And you're quite right, there is some solidarity, some fellow feeling, people feel it's a more green lifestyle. Is there danger almost of complacency, that people get used to this lockdown, and some people might want it to go on forever?
Yeah, I think that's true of sections of the wider public. The furloughing scheme is extremely generous, £2,500 per month. And for people who weren't earning huge salaries and who are sitting at home and aren't spending any money, that might be quite comfortable, particularly when they look at the risks of being infected. So I think some people have taken this easier than others, but I think there's a huge agitation in the business community to get the restrictions lifted as quickly as possible, and that is the pressure that is on the Prime Minister.
In terms of our links with the rest of Europe, in a strange way, Britain has become more empathetic with Europe. You mentioned just now, Norman, how we're looking at the statistics and the television pictures and so on from Portugal and Spain and Italy and so on. How confident are you that despite all the interruptions we've had in the last couple of months because of illness, because of video conferencing is not the same as real physical communication, that how confident are you that we will be on track to have the final phase of the EU-British liaison coming to an end now at the end of this year, with the interim phase on the 30th of June. It's going to be quite a difficult ask, I think. How confident are you we can meet these deadlines?
Well, I think in answering that question, or in asking that question, you have to make a distinction between the time needed for negotiation, that's the government's problem, and implementation. I can understand, taking the lack of implementation, why business is nervous about the prospect of dealing with a great change in its relations with Europe at the same time that it's still dealing with COVID-19. But if you take the first point, which is the negotiating period, the British government is well able to judge and doesn't need advice from outsiders. There's a lot of outside advice being given. Doesn't need outside advice about how much time it needs to negotiate. The British government knows how long it needs to negotiate. And the British government, I think, is in a stronger position than many people think. I think the EU would like the deadline to be extended because the EU has a lot of internal problems to do with the euro, the stability mechanism, etc. And it would prefer to have another year or another 2 years and shunt the whole question of Brexit to the side. The British government is adamant that it is sticking to the June 30th deadline. As I say, it's possible we might see a distinction made at the end between the negotiating period, which I think the British government is determined it's got to end on the end of December the 31st, and the implementation period. You might get a trade agreement agreed by December 31st, and then say, because trade agreements often have an implementation period inserted in them, it might say, well, we can have 2 years to implement this.
I'd like to get on to the longer term implications of this crisis in a moment, including the links with between Britain and ASEAN and China, and some of the things that Sam was talking about just now. But just remaining with Europe just for a moment, is there any chance at all, do you think, that this slightly greater solidarity that Britain might have now with the European Union in these months and coming months, that could lead to some total U-turn, and that Britain will rescind this idea of leaving the EU at the end of this year? Some people still cling to this thought. Is there any prospect at all that that could happen?
No, none whatsoever. That would not be a viable course for the Prime Minister to follow, and it's not one he wants to follow, and his party would never allow it, and it won't happen.
As somebody who's been in government during some fairly fraught periods of our relationship with the rest of Europe, what would be your vision for the best possible type of political, trading, economic and security relationship after the end of this year?
Well, I hope that we will have a free trade agreement. I don't see why that can't be achieved in the timescale of a year. After all, Britain is compliant with EU regulations. Everything is the same. Everything doesn't have to be renegotiated. What has to be renegotiated are the mechanisms by which this might be adjusted if adjustments are needed over time. So I would favour a free trade agreement. I think Britain, though, would be wise to, in foreign policy terms, have a very close link with Europe. At the moment, it's not envisaged that that should be institutional. I personally would not be against an institutional framework for that, but I think Europe and Britain do sometimes have different interests from the United States, and I think foreign policy coordination is a good thing. So I hope what we will have is a free trade agreement, economic relations in which Britain is a third party, but a foreign policy partnership.
Just one last question before we move on to other matters on British politics, Norman. Keir Starmer is now the leader of the Labour Party. He looks a more doughty opponent than Jeremy Corbyn. It was almost an open goal, really, for Boris Johnson, I think, in the December elections. What difference do you think Starmer will make to UK politics?
Well, I think you're right that Starmer will be a much more formidable opponent for Boris Johnson than Jeremy Corbyn ever was. Starmer is an accomplished lawyer. He's very precise. He's very forensic. the questions in Parliament will be very different. I think he probably can't believe that he has such an opportunity, because if this crisis went very badly wrong, you might well find that Starmer suddenly became an alternative prime minister. I mean, at the moment, because he's new, he's starting, people don't really know him, he's miles behind in the opinion polls, but that possibly could narrow according to circumstances. I think Starmer's political problem will be appealing to the traditional Labour areas that voted Conservative at the last election, the red-blue areas or the blue-red areas. There, a lot of people voted Conservative because they felt that they had been neglected by a metropolitan elite, and of course those areas of the country were very strongly pro-Brexit. And Starmer was the person who was very reluctant to accept Brexit. So that will be a bit of a problem for him.
Just in the remaining minutes, Norman, we had some encouraging words just now from Sam about the trade relationship between Britain and Singapore and the wider ASEAN region. Is there a great new market now available for Britain, do you think, in Southeast Asia, in the rest of Asia, and in China? Is this going to be what rescues us, so to speak, in coming years?
Well, when you say rescue us, I'm not someone who believes that by leaving the EU, we've got to sacrifice our trade with the EU and replace it with trade elsewhere. I believe we get a decent free trade agreement, which I'm sure we will. Our trade with Europe will continue broadly very similar to how it was before. But Britain ought to obviously develop increasingly close and accelerating trade with Southeast Asia and with China. I thought what was being said before was absolutely right. What we don't want to see, and there is a bit of this creeping into all countries, we don't want to see, I think he called it supply chain nationalism. The idea that because there have been problems over COVID, we should give up completely international supply chains and free trade, I think would be a great mistake. We've got to fight back against protectionism. There are going to be questions asked about China and China's role in COVID. These are health matters and political matters, but the benefits of international supply chains and free trade, I think, are genuine, and we must do everything we can to maintain them.
Just a final question on China. There has been some controversy about China's role. China, quite understandably, legitimately, from its point of view, is now trying to make the best of the situation and go into a world leadership position, given the fact that the United States is not taking a very strong leadership role at the moment. How do you see Britain's links with China developing in the next 3 to 5 years?
Well, I think unfortunately, because of COVID, I say unfortunately, I mean, China, I think, does face legitimate criticism, but I think people are becoming suspicious about China, insecure about China. I think this is very much American-led. It's understandable that the United States is worried about its own hegemony in the world being challenged by China. But I think America would be wise also to look for partnership with China, to continue to look for partnership with China. I think the world would be a poorer place if it was divided into technology zones, if Chinese technology was not available to American companies and American companies to China. I think whatever the criticism of China, China is a better place than it was at the time of Mao Zedong and so on. So I think while there are critical questions that should be put to the Chinese government, we do not want to have a new Cold War with China.
Good. Well, on that more hopeful note, and the fact that the sides do actually need each other, let's end this conversation with you, Norman. That's been really good. We've got over all the main topics in the last 15 minutes. May I wish you well. You seem to be coping quite well in lockdown land in Notting Hill. And thank you very much indeed. You do come to Singapore from time to time. And I know you take that part of the world very seriously, so let us welcome you to come to Singapore when everybody gets back to normal, as I'm sure we will sooner or later. I'm sure everybody in Singapore will want to see you in the flesh.
Thank
Good.
you.
Well, thank you very much indeed. You're welcome, Norman, to stay on the line if you'd like to. If not, you might want to go back to your bacon and eggs.
Yeah, thank you. Well, I've got a meeting.
Thank you for being with us, and good luck in Notting Hill. And let's all get back to normal as soon as we can anyway. Bye for now. Thank you very much for being with us. We're now going to go over to the rest of the program. We've got another hour where we'll be discussing with some well-known economists the outlook for Asia and the world. And I'm going to introduce now virtually Rob Carnell, who's the Chief Economist and Head of Research for Asia Pacific at ING Bank. Hello, Rob. We've got Chu Li, who's the Chief Economist and Head of Research at the China Construction Bank. Hello, Ms. Li, good to have you with us. Then we have Maximilian or Max Lin, who's in charge of emerging market Asia strategy at NatWest Markets, and David Mann, who's very well known as the Global Chief Economist, Standard Chartered Bank, based in Singapore, which is a change compared with the old days when Standard Chartered always had its very renowned chief economist based in London, so a sign of how things are shifting. And we're now going to be talking about the wider picture. We've heard from Norman about Westminster and where we are in the UK. We're now going to shift focus to Asia and the wider world. I'm going to start off with you, David, if I may, just asking you to provide an idea of the bigger picture of the global markets outlook. We've had this amazing rebound in the last 7 weeks of stock markets. Everybody thought that there was going to be a complete collapse. That's not been the case. Of course, we have to be reminded that exactly the same thing did happen in 1929, 1930. We had quite a big rebound before everything went pear-shaped again. So in a few minutes, can you just tell us what your view is? And we'll go over to the other panelists and there'll be time for questions at the end. Over to you, David.
Thanks very much. And it's a great pleasure to be here. Thank you very much for inviting me to speak. I would kick off with your point about the rebound we've already seen in markets, and I would put that down to a great degree to the muscle memory that there actually is in central banking around the world, particularly in policy making globally, in figuring out what to do to prevent credit crunches and to resuscitate the functioning of financial markets. And we've seen these alphabet soups being introduced yet again from that muscle memory of what was done more than 10 years ago during the global financial crisis. That is very useful, and it's been incredibly helpful that we've seen this QE infinity policies effectively being introduced in the case of the euro area as well as in the US, but we've seen even more aggressive policies coming similarly, or at least as much as is practically possible, across the world. Even in some emerging markets, you've seen what certainly looks like quantitative easing style policies, which are being described as open market operations and unsterilized interventions that may at some point be reversed. And it really links into the point being made earlier in how we should be just dealing with the current crisis and worry about what it looks like and what it means once we're through that crisis. And certainly there would be long run implications were you to see over aggressive amounts of monetization of debt going on, particularly around emerging markets. But that should not and is not, I believe, the big issue of today. Instead, it's more about dealing with the fact that you alluded to the Great Depression. We are in the midst of the biggest economic contraction in peacetime since the Great Depression. There's a big difference, though, that I would stress, and one similarity that I think is worth using when thinking through the history, which we always should be wary of. The difference is that at this time around, at least, we have a lender of last resort, and we have that role being played in an extremely strong way by the US, also providing swap lines and liquidity to central banks around the world, from the IMF stepping in, being asked by 90 countries for assistance, and they have various programs available for them, and at the same time preventing that lack of the buyer or lender of last resort. Any worries about, again, how it looks is again an issue for another day. Right now, that is the right solution to such an extreme shock as the one we have right now. It's a global shock impacting literally everyone. Of course, there's different responses to it on shutdowns versus less aggressive forms of it. Compare, say, Sweden to what we've seen, for example, across parts of Europe or in the United States or indeed around Asia, where we have quite a number of differences on how they've handled it to begin with versus how we're likely to go next. And I think this is the important point, linking into what you were just saying, that we know next, when we think about it, it is all about, well, can we come out of shutdowns? There's optimism about that, but what do we come into? And most likely, knowing that there is no vaccine that's likely to exist or be rolled out before 2021, and even then it's not for certain, then we are stuck with that relatively slower pace of recovery, knowing also that with all of the stimulus measures taken, they also may need to mean that governments will be leaning against recoveries when they eventually come. So maybe
thanks for setting the scene like that, David. You seem to be saying that the central banks have done pretty well so far, but particularly Uncle Sam, we should put our faith in the dollar and the might of the Federal Reserve, and that might well be the case. Let's go over to Chu Li now, because we heard a little about China earlier on in the conversation with Norman Lamont. China hasn't come out of this crisis quite as well as maybe the leadership would have liked, because clearly there are some worries and some doubts about cover-ups. On the other hand, China is now coming out and is recovering earlier than the other nations. Do you think there'll be any chance of Chinese leadership in the way that we saw after 2008, 2009, when China really did throw a huge fiscal stimulus at the breakdown and did help the world come out of recovery? Will we see similar Chinese economic leadership now after this crisis as we saw 10 years ago?
Well, first, thank you for inviting me to this great panel. I think a few things you asked, the economic impact and the policies. I think in terms of timing, indeed, China went into this crisis earlier, and now earlier than everybody else, and now its economy seems to be stabilizing and recovering. So I think the first thing I would say is that the evidence from China is that the economy does start to improve after the lockdown, even though the pace is quite uneven. So I think it's I agree with the other's point that it's hard to expect a very sharp V-shaped rebound in any case, because the sentiment is still being held back, especially on the consumption side. But nevertheless, if you look at the Chinese data, March rebound was quite meaningful. And the production especially rebounded faster than the consumption side. Now, in such a circumstances, what is the right policy? I think it's there is a question of sequencing and priority. When you are dealing with, when China was dealing with the crisis early in first quarter, I think most of the policies were about health concerns and controlling the virus, and also manage the economic side effect of sudden stops of activities. So the focus back then was not about economic growth. It's really about keeping the social fabrics alive and keep the societies functioning. So you see that government provided physical help to vulnerable group, to SMEs, encouraging them to keep jobs, keep employment. So I think employment was the first key priority. And the second priority was financial stability, because when the sudden stop of the economy happens, you could have a chain reaction. So what the government did back then was to provide targeted support, ask the banks to postpone some of the loan payment, and even ask some landlord to postpone rent for their tenants. I reckon not all these policy options are available elsewhere, but nevertheless, I think that's the sort of focus that the Chinese government had during the crisis time, really just to manage liquidity and also manage jobs, to make sure that the swarm doesn't completely overturn the society. Now, after the economy...
If I may interrupt, sorry to interrupt, but just one small question before I go over to Rob on the US and China. A lot of people have said that there should be a swap line between the Federal Reserve and the People's Bank of China. You might not think this is quite the right time to do it, but would you advocate that yourself? Because that's something I really want to talk about during this panel discussion, about whether the US and China can get their act together again. So a quick answer on that before we go over to Rob.
I think in reality it should have a swap line. Back to David's point in terms of the liquidity, there is a lot of offshore borrowers in dollar in China as well. So, but in reality, the swap lines are only available to a number of central banks. But if the swap line availability is limited, then you could imagine that the international dollar market, the stress could last longer. It could feed back to the US domestic market. So, it's also a dilemma for the Fed to address.
Okay, well, we'll probably come back to this overall question, I'm sure. Rob, I'd like to ask you, please, about the effects and the repercussions and also the response in Southeast Asia itself. How impressed have you been by the collective response, both at a national and at an ASEAN level, of the Southeast Asian nations?
Yes, thank you very much, David. Well, I think this has really highlighted how in a crisis countries tend to respond in a very somewhat nationalistic fashion. We've seen a huge spectrum of responses across the whole of Asia. I mean, if we widen this to North Asia as well. And really the response has been driven largely by what the COVID response has been. Let's remember that this is, for the most part, the economic hit that countries are experiencing now it's almost self-inflicted. It's the lockdowns themselves that are causing the real damage. Now, without the lockdowns, yes, there'd be a recession, there's global weakness, there's supply disruptions, but fundamentally, this is a massive demand shock and a massive supply shock on top of this. David Mann talked earlier about the central bank's response of all of this, and that's very important. That's really stopping a financial crisis from coming on top of this. And this has been right across Asia. We've seen central banks coming in doing whatever they can. But in many cases, this has highlighted, I think, where there are fiscal shortcomings. It's the fiscal policies that are going to be doing most of the heavy lifting here. The furloughing policies, giving cash handouts to people. And really what you're trying to do with this combination of policies is, one, prevent this big supply and demand shock combined turning into a financial crisis on top of that. Then it's game over. I mean, we've really lost the battle if that's happened. So the central bank's very important. But the countries involved have had to spend huge amounts of money. And it's been very different right across Asia. So those countries with huge amounts of money, if we throw in Asia Pacific as well, Singapore is a rich country. It's spent a lot of money. And it's come out with packages about 8% of GDP, and most of that's real money. It's going to be on budget money. It's found from the the huge reserves that Singapore has. Australia has another similarly huge policy of real spending, which is going to make a big difference. And what countries are doing right now with these sorts of policy responses, they're basically buying protection for their productive capacity. This is a temporary, fingers crossed, this is a temporary, albeit horrific shock to the economy. You don't want to come out at the end of this having been terribly prudent, managed to keep to some sort of arbitrary fiscal deficit target that maybe someone set to you or you've set yourselves. I mean, in the case of the EM countries like Indonesia, maybe it's the ratings agencies you fear most. But that's actually what you're seeing right now. If you're in that slightly awkward position, you're an EM country, you're running a current account deficit, you're in a much more powerless position in being able to respond to this in the way that really you should, which is just to chuck money at it to keep your economy intact until such time that you can come out and recover. And then this other worry about what happens if Fitch downgrades me. I mean, that's been the problem. So we've seen really big divergences. You can see it, for example, in the huge sounding stimulus package that Malaysia came out with, a couple of weeks ago, 18% of GDP. Well, no, it wasn't. There was a huge amount of fluff involved in that. And if you counted up everything and double counted it a few times and added in some soft loans here and there, yeah, you can come up to some massive numbers. But the reality is much smaller amounts of money. But everybody's spending.
I'd like to ask you, if I can just halt you there for a moment, Robert, and just ask you, if you were, say, a judge on the X factor, so to speak, and you were looking at the X factor of Southeast Asian responses to the crisis, who would get the maximum number of points, would you say, out of your ranking order in Southeast Asia, and who would get the booby prize? Just off the top of your head, just give us your thoughts, and then we'll go to Max.
Yeah, it's a tricky one, this, and I don't want to say too much, because so much of this relies on what was done to try and contain the outbreak in the first place. So Singapore looked to be in great position at the start, but maybe it's dropped the baton a little bit of that in recent times. As a result, with this slightly late approach coming into the lockdown, it's probably going to see a bigger economic hit than had it gone in hard and actually done the one thing that it still doesn't seem to have really taken on board, which is test, and then do trace isolate. You just can't do, the two on their own. It doesn't really work. You're always chasing your tail. The Philippines, bizarrely, I mean, you typically imagine this would be one of the economies in the region that would have, suffered on the financial market front. It's actually the peso has been remarkably strong throughout all of this, and partly because Duterte's strong man in the region has come down with a strong lockdown, but done it early. It's credible, and he's been rewarded by financial markets for that. I think the booby prize probably has to go to Indonesia. I don't think anybody actually believes any of the numbers that are coming out of there. So not only does it not look like they've got any sort of sensible policy in place to really contain the outbreak from getting worse, and the numbers aren't looking particularly good, but no one believes the numbers anyway. So you're being hit on the one side by this sort of COVID-19 overlay on the financial markets, and the second one, the credibility and trust issue, which I think is also hurting countries trying to respond in this crisis.
Well, thank you for being so frank. I hope you've got your visa sorted out for when you next go to Indonesia. anyway, it's very good of you to be so open there. Max, you're looking at the EM currencies a great deal, and Rob already mentioned the peso having been relatively strong. What general interpretation do you put upon the crisis when it comes to the safety and the reliability of emerging market currencies in the Asian region, and who's done best and who's done worst, if you like, from the central banking point of view? You need to go on to unmute, please. We can't hear you at the moment. Max, can you press the button? So, okay. Yeah, that's great. We can hear you now. Did you get my question okay? About
yes, I did.
The runners and riders. Thanks. Over to you now, Max.
Yeah, sure. Well, in terms of the ranking and who does better and who does worse, that's really most of the external makeup of what drives these currencies. So we've seen in the last month, especially in March, that Indonesia was the weakest currency of them all. And I think that partly has to do with the trust issue that Rob brought up, but it also just has to do with the fact that the bond market in Indonesia is very reliant on the USD investor. Around 35% of the Indonesian bond market is held by foreigners. So when there is a US dollar squeeze, where businesses are basically drawing down their loans, that creates dollar demand for banks in the US, they end up selling a lot of these foreign bond holdings. So it did hit Indonesia particularly hard because of that foreign bond presence in the US or in their bond market. But it also hit the Korean won quite hard as well, because we know a lot of foreign banks do participate in the KTP market. So although Korea has a better profile externally with a better current account surplus, the won was also quite volatile during this time. If I wanted to rank who did the best, I'd probably have to say it's Singapore in this case, just because not only are the fiscal reserves high, the foreign reserves are quite high, and the Singapore policy, of course, is currency driven. It is managed to be stable in trade-weighted terms, not just against the dollar, unlike Hong Kong. But because you have that policy, it basically reassures investors. That basically gives some scope for stability for the Singapore dollar. And the Fed has also been a big help here. QE Infinity was one plus. But as we talked about FX swaps earlier, the fact that the Fed reopened its Bank of Korea swap line to provide US dollar liquidity was also some relief. So the good news for Asian currencies is that I think most of the weakness is behind us. Now, I don't think the dollar will weaken as a result of all this aggressive Fed easing up until you see a recovery in US optimism as states reopen. But at least in the short term, I think most of the volatility, even for places like Indonesia and India, I think that for now looks like it's behind us.
David, perhaps we could go back to you now on this issue about currencies, because you're obviously following all the Southeast Asian currencies very, very strongly. do you think there's going to be more interaction between ASEAN when it comes to also regional swap lines? We have AMRO, which hasn't been heard of very much during this crisis. Is AMRO needed as a regional safety net? Do countries have enough reserves? We heard about Singapore, immense reserves to look after themselves. And also, where does this all leave Southeast Asia vis-a-vis the dollar? Is the dollar still going to be the main shepherding factor, do you think, for Southeast Asia rather than, say, the renminbi?
Well, I think certainly in terms of what the level of the exchange rate ends up being, the importance of the renminbi is critical, and it is important that we should note how relatively stable the renminbi has been throughout this entire period. Had it been weakening aggressively, you would have seen even more of an aggressive move, you could argue, in other currencies around the region that correlate to it so well. I would stress that on the dollar trend, a huge portion of this needs to be related back to also not just dollar renminbi, but also what's going on with the euro against the dollar. And unlike, for example, in the GFC era, where it was all about what is the relative balance sheet story looking like in the central banks and the Fed that was aggressive at the time versus Europe that had not yet got onto the QE bandwagon until its own crisis a few years later, it's a different story now. They're both in QE infinity, and you have the added stresses and risks, for example, associated with Italy, and whether or not you will see enough bailouts coming in time, depending on how things pan out. So it gets much harder to argue that there should be necessarily, in our view, immediate dollar weakness or even necessarily dollar weakness in the medium term as a result of not necessarily seeing a weaker renminbi or weaker euro. What exactly is the dollar going to be falling against if it's not those two, the most important two of all? Bring it back to swap lines, I would argue that the fact that anyone who holds US treasuries onshore in the United States is able to get hold of dollars through the repo facility that the Fed is offering, that broadens out the list of central banks who can tap in to get dollars without dumping tons of treasuries on the market. That's a useful line to have that should also make it even easier to add to some of the firepower and the credibility of central bank reserves. But a key question here is, will you see, for example, India going ahead with an even more aggressive fiscal stimulus package than anyone thought possible, and then also end up seeing it being effectively monetized, depending on how you interpret it? And will that be something people believe is permanent or temporary? Will you get panics about that? Anywhere that has double deficits in emerging markets, and I would go much further out on the weaker end of the credit spectrum, without external support, they will be in a much more precarious situation than if they do get it. So the IMF, World Bank plans and immediate liquidity facilities and short-term lending facilities will be vital for preventing even more aggressive currency weakness against the dollar over the rest of this year and even next year.
And just this question about AMRO, the swap line, the intra-regional mechanism, David, just a quick point on that. Is that going to be totally irrelevant because the Federal Reserve and the Treasury seem to be looking after everything?
It's better if it is just coming from some external source, you could argue. Certainly if it were done in a way that leaves people with some stigma from tapping into some regional facility, and that's assuming the facility really is there when needed. I'm not sure it's been tested fully to actually be proven in that way, but if needed, would it also be able to be done without stigma? Maybe the way that they could do it, and it was done, for example, when the Fed tried to work out how to provide swap lines to other central banks around the world, is to do it with a number of countries at the same time, so no one country feels that they would get singled out as being particularly vulnerable and in need of that sort of regional support. So it could
yes, that's always been the problem, hasn't it? Let's go over to you, Julie, and talk about China now in a more general setting. We heard earlier from Sam, and we heard this also from Norman Lamont, we don't want to go back to autarky. We don't want to go back to supply chains being reduced so much that countries rely simply on themselves. Is China going to be able to really make good in this new world where there will be some suspicion about long supply chains? How will China do in this new world where perhaps China itself will become less dependent on foreign trade as it seeks to build up its own economy? There will be, for all kinds of reasons, a restructuring of the world economy after the crisis ends. How well prepared is China for this?
Well, David, I think from China's perspective, it always stated that it wants to be part of the global supply chain. It has been the main beneficiary of the globalization and opening up. So I don't see any reason why for China itself wants to change that necessarily. But the reality is that you have the trade protectionism that has been going on for the last few years. Now, under the virus and the coronavirus, there are additional pressure that people are asking questions whether the long global supply chain is really the way to go. So I think my analysis, our analysis has shown that last few years already under the trade protectionism, some of the supply chain shortening is taking place, and some of the international conglomerates, they are thinking. I mean, some of them are thinking, some of them are already making B plans to set up other supply locations in other countries. So what we see in China is that because the import side in the last few years have become more volatile and less dependable, right? Because for instance, the chips and semiconductor imports, they are very much subject to the political decisions. What happens is this gives incentives to the Chinese companies or companies located in China to accelerate their technological advancement and investment. And we see last year, for instance, it's the import side that fell faster than export during the trade war. So as a result of the trade war, I think that's already taking place. Some of the supply import consolidation, import substitution is already taking place in China. And coming out from the coronavirus, I think a few things probably is going to happen. I mean, we can all hope that global supply chain is going to stay intact. And in fact, I think Chinese government has been saying that they want to stay in the global internet globalization, so global supply chain. But in reality is that I see the trend of number one, supply chain shortening, and number two, the duplication of supply in various locations to happen in coming years. On the macro scale,
I think that gives us some very good perspective. Actually, I've got a question for Rob in a moment about supply chains, but just one last question for you, Julie, on the Chinese issue and the United States. It's come in from a listener, actually. You spoke about Plan B regarding the economy. Does China have a Plan B for a change of president at the end of the year in the United States? It's a question from one member of the audience.
That's an interesting question. I mean, I don't, I don't understand U.S. politics, I have to say. And I think any president in the U.S., China has to manage its relationship with the biggest country in the world. So it doesn't have to, it doesn't have necessarily a different plan. I don't think it will change its official rhetoric because US, whether or not US has a different president.
No, thank you. I think that's a good answer. Rob, a question has come in which actually is tailor-made for you, and it's about collaborative partnerships in Asia. And the questioner says that there is a lot of collaboration now between ASEAN countries on the research and technology side. So is it right that a country like Britain is, as we heard from Sam earlier on, for example, seems to be concentrating very much on bilateral relationships, UK, Singapore, and so on? Should countries like Britain, where you've got some experience yourself, because you were in the long ago age, you were part of the UK Economic Service, when everything was much better, of course, should the UK be concentrating on ASEAN as a whole rather than picking off countries one by one bilaterally, particularly when it comes to these large technological collaborations?
Yes, my UK government experience is about a quarter of a century ago, where I was a very green and even worse economist than I am now. But what a great place to start. Yeah, I mean, the economics is not a fundamental science, but if we had, you know, fundamental laws like in physics, you know, our version of the second law of thermodynamics might be something like, you know, more trade is always better. Whether or not it makes more sense to do that on a multilateral or a sort of plurilateral, if I can make up words as I go along, for looking at regional bodies like ASEAN than bilateral, you know, I think for me the benchmark is multilateral. I think that's generally better. But the history is that they're incredibly hard to get those sorts of deals through, and we've lived through, you know, decades of lack of progress on these things. So perhaps actually, you know, the law of second best is let's do something which we think we can actually do, rather than aiming for the, you know, for the moon every time. And so, you know, something in the middle, regional trade deals might well be a very good approach. Now, I think that the point about ASEAN is, you know, whatever we think about supply chains in China, and they are changing. They were changing before COVID. They were changing before the trade war. I mean, China isn't a super cheap place to make stuff anymore. So the reason you want to be producing in this part of the world is because they're a huge consumer now. So, you know, 40% of all PCs globally sold in 2018, I don't know the 2019 figures, but it'll be bigger rather than small. 40% of them sold in China. Now, they probably make the same sort of statistics about huge numbers of different sorts of goods. So you want to be producing relatively close. Geography still matters. And the infrastructure to get those goods from bits of ASEAN, from bits of Asia back to China are very important. You see that the countries in the region that have been doing the best are typically the ones that have invested most in infra. And I think that's going to be the case in the future. So yes, it does make sense for Britain to look for partners in the region with perhaps a sort of second view on, well, maybe this is a good way to actually get into China. We don't necessarily want to set up a new greenfield site in Shenzhen somewhere, but, you know, perhaps we can get into China through the back door, through the ASEAN route. That might be a very sensible way to proceed.
Good, well, thank you. I'm sure there's lots of people listening who are very interested in the whole infrastructure area, and that is a really good theme for future discussions. Max, just staying on the Chinese theme for a moment, we heard some fascinating ideas from David just now about the overarching role of the dollar. The renminbi is something which clearly enters all of our minds, and we've seen this issue about the international role of the renminbi. Once the dust settles on this crisis, once we get over all the arguments, maybe there'll be a new president in the United States, maybe there won't be. Where does this all leave the international role of the renminbi, do you think, taking on say a 5-year role and trying to leave aside the present froth over this monumental crisis? And also, for those of you who don't know, Boris Johnson has just had another baby, or rather his fiancée has. That's just the news that I see on the news screens anyway. Nobody quite knows how many sons or daughters Mr. Johnson actually has, but anyway, this is a new one, and it's a baby boy apparently. So congratulations to the new family Johnson. So Max, over to you now on the renminbi.
Sure. Well, first I'd like to say best of health to new baby Johnson. And for the RMB, I think the trajectory of the RMB, I think, will still be gradual, and it will start acquiring reserve currency status. I think 5 years is probably a little bit too quick, even before COVID, even before the trade war. I think that when you think about just behaviors and just how long it took for the dollar to accumulate this status, that's not something that could be changed in even a decade or so. So you could see this as a short-term setback, how COVID is basically impacting dollar demand, and how that could be looked at as a short-term sort of test for the RMB. But in the grand scheme of things, when we're talking about 20 or 30 years, I do think that it will be a relative blip in the RMB's ascent as a global reserve currency. I don't know if it's going to supplant the dollar in that time frame, but because China is basically the largest trading partner for almost every country in Asia and for most countries globally, I do think that there will be a trend of settling more trade in yuan, in RMB, rather than the US dollar. And I think that's just a matter of when China basically wants to allow more free flow of capital across the onshore market into the rest of the world. So we know that the offshore market is still quite convertible, and I think it's a matter of time before they basically start loosening the capital controls for this tap in. I suppose the good news for Asia, at least in the short term, is I do think that the RMB will be more stable. One sort of blessing in disguise from the legacy capital controls is that China's onshore banking system is not really reliant on US dollar funding. So Toy Lim did mention that a Fed PBOC swap line would be very helpful for offshore Chinese companies, and that is true. But at least when you think about the onshore exchange rate, it's not very sensitive to this sort of US dollar demand. It really just tracks how strong the broader dollar is trading. So it's good, I think, that the RMB is an anchor for Asian currencies in the short term. And I also think that it is good for Asian currencies in the long term, that it does acquire a more global role. But again, I think that's a 20 to 30 year time frame, not just 5 years.
Thank you, Max. David, several questions have come in about India, and India was mentioned earlier on, and the peril of the twin deficits. Perhaps I'd like to ask you to be our genius on India for the next few minutes, because India will benefit from this fall in the oil price. That's true. On the other hand, it's got a slightly chaotic health system. There's also this issue about the internationalization of the rupee. Will that be something which happens in the next 5 years? Put on your crystal ball, tell us how well you think India has done so far, and whether India could end up being a winner or a loser from this crisis.
Well, it's a very, very tough situation for any economy that has so many concentrated areas of population, as, for example, India does across multiple cities, to deal with something like this. Just social distancing is just so impractical and difficult to actually achieve. So the shutdowns they've done, of course, like most places that have done it, it's on that humanitarian imperative of trying to slow down the pace of spread of the virus. But the depressing part really is that for India, as is true for everywhere else, let's think through all the scenarios you have. There is literally no scenario that's realistic that involves rolling out a vaccine or a treatment in 2020. Even if it's discovered by June, most likely it's 2021 before you start actually administering that vaccine. And if it's a treatment, whether it'll still be around the same time before enough of it is likely available. And that's assuming we have a rapid pace and the optimistic scenario actually happens. So in places such as India, where you have these shutdowns, the challenge is, as we were talking about, it's got those double deficits. Of course, the collapse of oil prices is helpful, but the bigger challenge domestically is, as now is the case, the RBI, everyone, I would expect the IMF too, is encouraging India to go ahead with fiscal stimulus measures to prevent an even worse outcome for fiscal policy path late for fiscal dynamics later if they don't act to try to prevent even more of a downturn in the short term. By our estimates, just with what's been done so far with shutdowns, we've gone from what could have been a year of at least say 5+% growth down to something a bit closer to barely growing at all, just about 0.7% growth. Now, if you had a scenario where by the end of the year, or maybe September, October, after they have released the populations from the aggressive versions of shutdowns and we're feeling our way across the river stone by stone, they realize there's more of an outbreak happening, then you need to go backwards again. And again, this is a story that applies anywhere, but in India's case, that would be automatically, we would argue, meaning you get a negative growth and even more economic pain. The challenge that India had was during the time when they were rolling out the policy of going into the lockdowns, when you had migrant workers trying to get back home that weren't able to, that created a huge extra amount of social stresses. To do that on a multiple times would be difficult. Also, let's not forget, can you bring people back once they've already gone, once you do reopen again? Is that possible? Is it practical? And all of these things will get in the way of the recovery that we think we will start to see. But then you throw in other issues, and India has a relatively high portion of consumption within its economy, as is true in many places around the region in Asia these days, more than it was 20 years ago. And knowing that, you have a traumatized population of people that realize how vulnerable their lives and livelihoods are. And as a result, you may well see a pickup in trend savings rates, which means even weaker recoveries than you would have had otherwise, even assuming the businesses themselves.
Good. Well, more questions than answers, I would say. And then just a very quick issue, the internationalization of the rupee. It could be I'm the only person interested in this exotic subject, but what is your one-liner on that, David?
I'll try and keep it brief. Short term, I would argue there's not that much likely to change on that front. Eventually, it could get more and more used, but I would expect that the real focus should be more on the renminbi when thinking about internationalization.
Right. Okay. Well, that segue back to the renminbi, to Lee. I've got a question for you, which has come in about aviation, and if I can maybe apply this more generally to tourism. China has been a massive generator of tourism around the world, and many shops, big and small, all over Europe, rely on Chinese patronage, if you like, for keeping going, particularly high-end shops. Will we be seeing an end of Chinese tourism now to Europe in particular? And also, where does this lead the global aviation industry? There's going to be state bailouts of many airlines, British Airways, Lufthansa, both in a very parlous situation. How will China do in the world aviation stakes, given the fact there's going to be state control, state support packages for airlines all over the world? So a twin question to you, please.
Well, I think that very much depends on the development of the virus and the vaccine. I do share the view that it's probably not something that's going to happen very soon. So unfortunately, I think tourism, like catering, is something that's going to come back more slowly than other activities such as manufacturing and maybe even construction. So I think in terms of recovery in those areas, it's going to be slow. Within China, you see that the intra-traveling is warming up already, but border controls is still very strict, and the government does worry about the second wave. So does all the other governments. So I don't think at this point, the relaxation of cross-border travel is going to be a top choice for any government. And even if they do, I don't think the traveling will pick up very soon. So that just speaks to the airline industry. I think in the near term, the outlook is not very good. But it's like other industries. It's disproportionately affected by different shocks. So this airline industry, I think it will be more affected than other industries, and probably the state support will just last longer.
So actually looking at the rest of the world will become more Chinese, won't it? Because airlines in Europe, for example, that have been painstakingly privatized over the last 20 to 30 years will possibly be taken back once again into state ownership. So we'll see a kind of Chinese style airline industry in Europe. Do you think that's likely, Ms. Li?
Well, I think in China, some of the airlines are being privatized. So I think, it's the circumstance where the state support is, or state ownership is expanding its reach during this crisis time.
Yeah, it could be a reverse set of trends. That would be really interesting. Rob, a question for you has come in, a really sophisticated question for a sophisticated chap like you on ratings agencies. And the question is, that, in the financial crisis of a decade ago, we saw a lot of gaming going on between the banks and the ratings agencies, with the ratings agencies and the banks dancing around each other and alternately being blamed for causing crises or being blamed for not doing enough to give investors due warning of accidents that were going to happen. Are we seeing the same thing happening this time round? The questioner asks, particularly our ratings agencies, by not giving the full facts about certain countries, preventing central banks and governments from doing what they really need to do. And of course, we saw a reminder of this just in the last couple of days with Fitch downgrading Italy one notch, although still just above junk status. Standard & Poor's refrained from doing that on Friday. So we see a real life example in Europe. But what is your general feeling about rating agencies and banks?
Yeah, I'm glad you asked me about that. I might dabble or skip gently around the banks issue. It's one of the things working in a bank, they do advise you generally not to talk about them.
I'm sure nobody's listening to what you're saying, Rob.
Oh, no, of course not. No. So, but I think there's a couple of things to think about here. One, I'm actually delighted that for once, banks are not being seen as the problem or the instigator, if you like, of this current crisis. And at times they're being talked about as part of the solution to getting economies back on their feet again. So that's nice. On the ratings agencies, and I'm sure I won't make any friends by saying this, I think we all know pretty well what the problem is. And I don't think it's really particularly helpful to have outlook downgrades from Fitch or whoever else. We had one in Australia a couple of weeks ago. Now, this is probably it was an outlook downgrade rather than a proper, downgrade. It was an outlook downgrade to the sovereign debt of Australia. Now, this is probably one of the most fiscally prudent economies on the planet. I mean, they have, they're way ahead of most of the rest of the world when thinking about things like intergenerational financing. Their total debt to GDP is about 40%. They run extremely tight ship. So this wasn't really helping anybody. Now, Australia, I think, will probably wear this as a badge of honor to say, okay, they've downgraded us. What it's telling us is that we're spending enough money, and they've chucked money at the problem, and they'll bounce back strong. And I think the financial markets are showing that Aussie dollar's been in an ascendancy recently. But I think actually this highlights a broader point, that by downgrading or downrating the outlook for economies now that really should be spending a lot of money to protect their economies, the ratings agencies might actually be deterring them from doing exactly what they need to do. And you go back to the comments I made earlier about, say, Indonesia or perhaps Malaysia. You don't want them to be running an extremely prudent fiscal policy right now. You want them to make sure that when this ends, they've got an economy. I mean, it's almost that simple. And they should be spending whatever it takes to ensure that in this interim period, all their firms don't go bust, because they don't go bust and come back again. They go bust and disappear. So no point coming back and growing at 8% if you've lost 50% of your economy. That's
yes, I can see your point for balance being needed, and we don't want to quiz you on the banks, but you're absolutely right. The banks haven't been the people at whom one should point the guilty hand this time round. But very quick answer, and I want to ask Max something. Rob, how well do you think the ratings agencies have learnt the lessons of the 2008-2009 crisis in this crisis? Would you give them, 6 or 7 marks out of 10 for at least learning from the past?
I don't think they have learned a great deal from the past. I think actually they escaped very, very lightly in the GFC, and I think they're continuing to operate very much as before. So I don't think very many lessons have been learned at all from the ratings agencies.
Oh, good. Okay, well, that's a subject for another discussion, I would say, with all our friends from the ratings agencies there. Max, a question has come in, slightly peeved question. Why haven't we mentioned Thailand? Why haven't we mentioned the Thai baht? Because Thailand's got a pretty good control of the health situation, the questioner says, and the baht has done quite well. So why aren't we mentioning Thailand? So your chance, Max, to mention Thailand in either a positive or a negative light.
Sure. Well, I do think Thailand has handled the situation pretty well, but I don't think that will really benefit the baht, because what is a huge driver of the economy in Thailand is tourism. So in 2019, tourism accounted for 20% of the Thai economy. And if you just think about direct tourism receipts onto the current account surplus in Thailand, just the tourism from Asia is around 7 to 8%. Right. So if you assume that trickles down to 0, and it's not 0, we saw that the March tourist arrivals fell by 75% year on year. If you just translate that into the lost economic activity, we do know that there will be lower demand for the baht just because you have less travelers coming in. Now, on top of that, the Bank of Thailand heading into the COVID towards the end of 2019 was always complaining that the baht was too strong. Right. So Thailand had this interesting scenario of having a very high current account surplus. It had a lot higher exports and services exports relative to imports, which made it a bit like Switzerland. And in 2016 and 2017, it had around 11% of current account surplus. That's similar to Switzerland, a haven currency, which is why you saw a lot of baht strength in the previous years. Now, year to date, the baht has weakened, not materially worse than other Asian countries, but quite significantly. And I think that's just because the Bank of Thailand wants a weaker baht because it's seeing what's happening to the tourism economy in Thailand. And on top of that, you just have weaker growth, weaker indirect spending of all the industries that are there to support tourism. As that dries up, I think that the baht will continue to weaken, and I think that the Bank of Thailand will sit idly by and say, like, this is what should be happening because a huge part of our economy has been decimated by the virus, and we need a weaker currency to recover from that.
Good. I think that's given Thailand a good balance in the discussion. So thanks very much for saying that. David, a question for you, and also something I know Standard Chartered cares deeply about: sustainability. Will sustainability simply be lost as a consideration as the world tries to struggle out of the crisis?
Well, I would argue that there's at least a debate, and I think you raised it when you were talking to the Norman Lamont earlier, where you were talking about how people have noticed pollution levels going down so much, improved quality of air, the revivals of certain parts of lakes or rivers with fish being seen that hadn't been seen there in so long. If you end up with one big thing that could come out of this, I doubt it will necessarily be that we end up going extremely further down the, I would say, the not caring route, given we already know that the big issue we have in this scenario, if you take the GFC, that was all about lack of capacity for the banking sector to deal with a shock. If you take this one, it was about the health system inability to deal with a shock, and therefore you couldn't even try and build herd immunity because you didn't have enough ventilators to enable you to do that, for example. And with the potential for future crises, it's all about climate crises. If you don't do something and build capacity to at least reduce your risk of going into it, it should, you could argue, the Green New Deal, those types of policy initiatives could be regaining even more popular support. But you're right, set against that is the practicalities of, okay, but is it actually going to be driving growth, or is it a nice to have that's just popular for now and that will fade away quickly? I don't think I have a firm answer on that. I would like to think that we see even more government initiatives and incentives to push us in that direction. With oil prices down as low as they are, I would argue the challenge really isn't about what's going on now. It's the fact that we have now so much supply disruption across West Africa, many other producers in the US, Canada, Mexico, Brazil, and elsewhere, where eventually, and most of that supply won't be able to come back. Once you switch it off, it doesn't come back. If you get a spike in oil prices later, and you've got this combination of this worry about the so-called house on fire that no one's doing anything about from the climate crisis, then maybe you could get even more of a focus on doing the right thing and more financial backing to that to ensure that actually happens.
I think that might indeed be happening. It'll be sustainability, but it'll be through a different route. We've had an inevitable question about the Belton Road, which clearly I'm going to put to Hugh Lee. We haven't heard all that much about the Belton Road during this crisis. Will this enormous emergency be a stimulus to China's efforts to extend this infrastructure corridor, including on the whole banking and regulatory side? Also, attending this question is the issue about debt forgiveness. There's many countries along the Belt and Road that have got into financial difficulties and will do so even more now with the crisis. And there's this issue about whether China will turn debts into equities and take stakes in places like Sri Lanka and Pakistan in strategic facilities, which may not be very good for China's overall name in those corridors. So what are your general feelings about how the crisis impacts China's policy on the Belt and Road?
I think in general, there has been a lot of internal debates on Belt and Road. I mean, the broad direction is still very much there. I think China does want to build its international network and also promote globalization through Belt and Road initiatives. But definitely the debt sustainability issues, and also for Chinese lenders, the risks involved on the lending side, it's also, it has been a key issue in the last few years. So even in domestic circles, you will hear a lot of discussions on that. But I think it's very much, in my view, still a discussion in terms of how to implement it, not whether to implement it. I think the direction is still there. And the debt forgiveness, on the back of the coronavirus, I think that's more an international conversation. Indeed, a lot of these developing countries will become more indebted. So how do you separate the short-term indebtedness coming from coronavirus and separate that from long-term project financed indebtedness? I think those are somewhat different, but in the end, it has implications. Both of them have implications on state budget and repayment. So I think it's going to involve multilateral conversations, not just China, because a lot of these countries also borrow from international organizations as well.
Good. Well, that's another big subject for discussion at the Singapore British Chamber of Commerce, I would say. I'm getting a whole forest of different questions coming in the last 5 minutes. I'm going to put two to you, Rob, so we can get through the questions in the last 5 minutes. One is on British companies trying to do business in ASEAN. With the air travel now closed down, it's more difficult to do the actual physical meetings. The questioner asked a really good practical question. Are we going to have to rely more on virtual meetings? What would your advice be for people trying to get into the infrastructure area? Should we just forget about it for a couple of months, or should we do our best through the virtual medium? And then associated with that, another very good practical question from an expat who says he's a bit worried about his pension. What should he do with stocks and shares? Should he go back into the market or not? So two very practical points for you, Rob.
Right, really quickly. You know, I think we have to do what we can do in the current environment. I think this occasion alone is a very good example of what we can do through virtual media. You know, let's suppose, and I fully subscribe to everything David said earlier about, you know, being skeptical about the availability of a treatment or a vaccine in 2021, which I think financial markets are in some sense priced in fully at the moment, which I find a bit perplexing. But we probably aren't going to be traveling as much anyway in the future. You know, I'm sure I will be encouraged by my management to do far less travel in 2021 for all sorts of reasons, which you know I don't have to spell out here, but and it's going to be much more than just the coronavirus. So my PPS card with SQ looks at serious risk right now. But I think actually you can do things quite well with virtual media. This has been an excellent demonstration of that. As far as the pensions go, you know, I'm a perpetual bear in terms of equity markets, but I also realise that the markets also do far better than I ever think they're going to. I mean, I know that the equity investor typically is a very sort of happy-go-lucky chap and will invest in every time there's bad news. I think, oh well, the Fed will just cut again. I'm just going to buy more. It seems to be the way that it works at the moment. You know, the levels in particular of US stocks do look quite high. I think a lot of the policy has been priced in. It's hard to see where you're going to get additional stimulus there. So I'd struggle to see this. We're also going to face at least a quarter of absolutely, you know, unmitigatedly terrible data on an economic front. I'm not sure that's quite been priced in. So I'm personally not a buyer, but I wouldn't be selling out either. I just sit scratching my head looking at this, thinking, okay, it'll come and it'll go, and we'll hopefully be at the end of it.
Too early to go back in, I think. I'm going to ask everybody a very final question at the end, but just a point for you, Max. Outlook for interest rates and inflation. Let's just take the United States then on this. What is your quick one-line view about interest rates and inflation in the United States over the next year, shall we say?
Even if things improve, let's say the states start opening up by late June, I think that the Fed has already laid out it's going to try to keep economy or keep the monetary policy as loose as possible. So I think it's basically going to stay unchanged, even if you get signs of a V-shaped recovery. There's no way that the Fed's going to hike and snuff this out, any kind of recovery that's needed. And on the inflation front, I'd say that there's no signs of real inflation in the US yet, even though you are getting signs of supply shortages for certain things like medical products, protective equipment. Other than that, I think there's no real signs of inflationary pressure.
No, that may be something else for the day after tomorrow that we don't need to worry about straight away. We're getting into the final minute now, so I'm just going to ask all of the panelists in the order in which they spoke. One questioner has said, crises like buses come in threes. I'm not sure what he referred to as the first bus, but he's expecting another crisis to come along fairly quickly. And so I'm going to ask you in reverse order, so you have more time to think about this, Max. But sorry, I'm going to ask you in the initial order. So David first, what is your bet for the next crisis? And Max, you will have the last word.
Wow, so we're already focused on the next crisis. Well, so far we've avoided the financial crisis this time around, at least in the immediate term. You could worry a bit, depending on how policy turns out from getting support from external sectors, about some sovereign debt crises in selected economies. If that leads to some contagion, there is still that persistent risk that I would worry about. And then the other big one would be whether or not you get a major hit to growth coming from the US-China trade war taking off as a result of maybe some political calculation in the United States.
You've given us three crises to worry about rather than one. So Julie, next crisis, your bet.
Oh, I just say one. I think given that how much the bond issuance is going to be in advanced countries. The question is whether we will still have very, very low interest rate in the next 10 years, as we did in the last 10 years. So if long-term interest rate does start to rise in a very heavily indebted world, I worry about another round of debt crisis and impact on emerging markets.
Rob, give us something to worry about.
Well, it's always not the crisis you've just had or the last two crises you've had. So something completely different. So I don't think financial crisis. I would say let's think about food supply. Something completely different. We're going to see some permanent hits to supply chains across the world. You know, we've already seen a few shortages on our shelves. Perhaps that becomes the new thing that we have to worry about going into the 2020s.
Max, tell us something that should be keeping us awake, not just at night, but maybe during the day as well.
Sure. Well, I'd say the domestic political upheaval in almost all countries due to the inequality that's being exacerbated by this crisis. So just anecdotally, a lot of the US programs that are designed to help the broader economy are actually getting taken up by larger companies. And a lot of the benefit is kind of going through, I guess, more well-to-do white-collar workers as opposed to blue-collar workers. So we've seen how populism has affected politics during Brexit, during the US election in 2016. And my worry now is that if it spills over more into a geopolitical realm, so if it exacerbates US-China relations by, you know, raising this blame game, that's sort of the next type of flashpoint I'm thinking about.
Okay, well, thank you very much, all of you. You can hardly say we've ended on a very uplifting note, but it's certainly been very stimulating, this debate. I think it's worked well. We've had some fantastic questions from the audience, and I would think there'd been better questions than we'd get from an audience were it to be a physical meeting. Something about this virtuality has engendered some very febrile questioning, I would say. The technicalities have worked pretty well. We've all been able to hear each other rather well. I think it's been a good experiment. David Kelly at the Singapore Chamber, thank you very much indeed for putting that on. And Julia and Adam, my colleagues, thank you very much for helping to organize this. Hugh, thank you for your words of introduction. This is David Marsh from London saying thank you all very much for being part of this. I'm sure it won't be the last virtual conference we have. You've been very enlightening, and not always been totally upbeat, but you've given us really good things to think about. Many thanks to you all, and enjoy the rest of the evening in Singapore and the rest of the day everywhere else in the world. Bye for now.